What we'll talk about in today's video is how you can buy a car with a whole life insurance policy. What we'll focus on, though, is the whole life insurance product. We'll talk about how it works. Specifically, what happens when you take a loan against the policy? How does it affect your cash value and your death benefit? What happens when you pay it back? If you make a payment, how much goes toward the loan interest and how much goes toward the principal? We're going to look at exactly that today. Let's get on into it and have some fun talking about life insurance. So for today's case study, we've got a 30-year-old female. She's interested in a whole life insurance policy, and her plan is to fund $10,000 per year up until the age of 60. So what she wants to do here is, one, save money for retirement, but then along the way, she wants to be able to use this for car purchases. Meaning she does not want to just sock money away and then eventually have it when she's 60. No, she wants to be able to use it, and knowing that when she uses the life insurance policy, she still gets the same interest she would if she never touched it in the first place. That's why she's interested in this. You'll see exactly what I mean when we look at the numbers. So with this guy, we've got 3 steps really to simplify how this works. If you're interested in buying a car with a whole life insurance policy, step 1 is saving money. That means you're putting money into the life insurance policy and your focus is cash value. Step 2, take money out to buy the car. That's when we take a policy loan to go out and purchase that car. And then step 3, put the money back. That means we are paying back the policy loan we took. Make sense? All right. So to start, she's 30. She plans on funding $10,000 per year. Step 2, at 35 years old, she is going to buy a $30,000 car. She's going to do so by taking a policy loan. Then what she's going to do is pay that back at $5,000 per year. Now, she's putting away 10 grand per year up until 60. So during this time period, she will be putting away $10,000 and repaying the loan at $5,000. So we want to be aware of that, and you'll see the numbers laid out side by side as well. Then, when she's 45, she says, I really want to get a nice car one day. I'm thinking a nice Jaguar. So that might cost me 100 grand down the road. We're going to look at the same thing with a policy loan. In this example, though, we'll repay it at $12,000 per year, or $1,000 per month. When it comes to loan payments, she can pay them back however and whenever she wants. She could even not pay the loan back if she wanted to. We'll cover that in a video another time. So those are the 2 examples we'll look at. And then what we'll also look at the end is, what if she just wants to stop funding the policy early? Meaning, what if she funds it at $10K per year for 5 years, uses it for a loan, but then when she pays the loan back, she says, hey, this is too much. I can't pay the loan back and pay the policy. Can I just stop paying the policy and focus on the loan? The answer is yes, you can do that. So we'll look at exactly that. So let's begin with the illustration here. And what we've got is a policy with one of your 4 major mutual companies. And she's putting away how much? $10,000 per year for the next 30 years. How much is that? $300,000. Now, the one thing I want to mention here, in case you are new to this, you've got $10,000 per year going in. Do you think that she has to pay that every year? Is that the amount she's billed for and must pay, otherwise the policy will lapse? No. The minimum premium is up here. It's $1,100. Meaning if she has a slow year or paying 10 grand is a burden, she can always drop it down to the 1,100. Maybe she drops it down, not quite to that number, but 3,000. My point is, it's very flexible where we can pay just the minimum, scale it up to 10K. We don't want to set it up where she is forced to pay this large amount every single year. So let's look at this policy, but with loans. And we've got the loan illustration. I'm not going to walk through this thing though, because does that look fun? No, right? Here's what I'll mention though. At 35, there's the 30K loan. And then at 45, there's the 100K loan we mentioned earlier. So this just shows that what you're going to see on Excel is exactly what you see on this illustration, just simplified. So here's what we've got. The growth illustration. This column, cash value growth. What do you think this shows? This shows the net dollar amount you are getting from the insurance company. First year, it's negative. Do you know why? You paid in $10,000, you have $9,200. $9,200 is less than $10,000. That's why we are in the red. The second year, you added $10,000 to your $9,200. Now you're at $19,000. Did you get your full 10 back? No, you didn't. That's why we're in the red. First 2 years are the worst years of a whole life insurance policy. I want to make sure that that is crystal clear before I put money into this product. Where people have a ton of buyer's remorse is when they are led to believe that they have a positive cash value or a positive return early on, when it is just not the case. Now, as time passes, it does pick up. This is looking at the net growth every year from the insurance company, meaning it is excluding our payment. But let's look at loans. And the last thing I'll mention on this is when we look at loans, when your money is borrowed against the policy, you are still getting this. So regardless, if your money is in the policy or if you've borrowed it, you're still going to get this growth. That's why people typically use these products. So what we've got on the right is the loan illustration. What do you notice here? I want to walk through these columns first. This way, when we look at the numbers, you can see exactly what's going on. So annual funding, that's what she's paying in premiums and PUAs. This is how she's building the cash value. Annual loan, this is money that she's going to take from her policy. So at year 5, she's going to get $30,000. Meaning when she borrows it, she'll request a loan from the insurance company. That $30,000 will be sent direct deposit to her bank account, which she can then use that to go out and buy the car that she wants. Okay, then we've got the loan balance. Then in light blue, we've got our loan payment. Anything in blue is what she's paying in. Annual funding, that's how she's building the cash value. And then in light blue, those are loan payments. The next 2 columns in purple, we've got the principal payment, meaning when she makes a loan payment, we'll see how much is going toward the principal. And then in light red, how much is going toward the interest. And then you also have your cash value and death benefit. So before we go further, at year 5, she took a $30,000 loan. The amount that she can borrow was based on the cash value in year 5 prior to that loan. It was $51,000 and change. So she had 51 and change. She took a $30,000 loan, and now she has just about 20 left that she can borrow again if she'd like. So when you take a loan against a policy, we do see the cash value drop. How about the death benefit? Back to this guy on the left. You were at 471. You took that $30,000 loan, and the death benefit dropped to 441. See what's going on here? I took a loan, my cash value and my death benefit dropped by the amount that I borrowed. Okay, what happens if I pay it? So her plan was to repay it at what? $5,000 per year. So here's your $5K per year payment. We can see how much is going toward principal and how much is going toward interest. This illustration assumes MassMutual's December 2024 variable loan rate of 5.1%. But when she's paying it back, you can see the principal balance here going down. And if we look at the bottom here, loan balance is gone. She's paid it off. Your cash value, 184. Your death benefit, 785. If we go back to the example on the left, look at that. 184, 785. It's fully restored to exactly what it would have been as if I never touched it in the first place. That means she's still getting this all the way through. That means she can put money away for her retirement and then use the money, in this example, to purchase a car, knowing that she's not going to lose time. Because if I had it in my savings account, and that savings account is earning 5%, for example, if I take any money out, I don't earn interest on the money that I've taken out. Whereas with this, she says, okay, it keeps on compounding. I can pay it back however I'd like. The drawback here is that I do have a cost to borrow, which if I'm going to finance it with an institution, a car dealership, I'm going to have to pay interest as well, which would be true. Now, if her interest rate is lower with the dealership or bank, we might look at that instead. But there's the $30,000 car. Then we've got the same thing with the $100,000 car purchase. So here's the Jag. Vroom, vroom. She feels like James Bond. When she takes that loan, you'll notice the cash value and death benefit. Same thing happens. Drop by the amount that we loan. Then we pay it back. When it's all said and done, there's your cash value, $535. Over here, $535. No lost opportunity cost. I don't lose time here. So my money continues to compound. And now, when I hit 60, I've got that same $650,000 at the end of the road. So that's how a life insurance policy works when I'm going to use it to buy a car or use loans in general. All right, let's hit on the last item, which was, what if I want to use this to buy a car via policy loans, but the idea of funding it and paying the loan back is just too stressful. So let's take a look. We'll just look at one loan here to keep it simple. So on the left, same policy. You'll notice that the values are identical through the 5th year. The difference, no more payments after the 5th year. You can do that, you know. Even if you didn't plan to. Your plan was to fund for 30 years and then you want to stop after 5. You can do that kind of stuff. It's not as if you're locked into paying it forever. If the premium is low, that's a big point to mention. In the 5th year, she takes that $30K loan, exact same thing with the cash value and death benefit. The difference here is because we're not funding the policy anymore. She says, hey, the $10K I was paying, can I just pay this back faster? Yeah, no problem. And then you see how much is going toward principal and how much is going toward interest. The end of the payment schedule, there are your values. Compare them with what you've got on the left. Everything's the same. See what's going on here? Key lesson is if you are going to use a policy to purchase a car, the benefit here is knowing that my money keeps on compounding for me. An added benefit is that I have complete control and say over how and when I repay that loan. What some people like to do is pay interest only for a period of time. And then whenever they come into money, if they're in sales, for example, or they're selling a piece of property and money's coming in, they'll take those lump sums and throw them at the principal. But to start, they'll often pay just the loan interest. That way the loan doesn't compound, and then they'll attack that principal at their discretion. Some people like that instead of just setting up a stringent payment like $5K or $12,000 per year. So I hope you enjoyed this case study. Please let us know your thoughts in the comments below. You can also DM me as well if you have any questions at all. And as always, I hope this helps.